What's happening in the world of forbearance? That's what we're going to talk about in today's video. We're going to dive into the latest report from Black Knight with regards to their mortgage delinquencies and talk exactly about what's happening in the world of forbearance. What's happening when people are exiting forbearance? How many people are still delinquent? What does that actually mean? We're also going to talk about the 10 most affected cities with regards to delinquencies, which states will likely or which cities are likely to be hit the hardest if these forbearances actually turn into real delinquencies, turn into foreclosures, which market is going to see the most of them, and what types of loans are being affected the most, which have the least amount of equity out there right now with regards to the number of delinquencies, what's happening with those loans in the forbearance world. That's what we're going to dive into in today's report. Last week, we did a video where we talked about forbearance, and we talked about a lot of people exiting forbearance and getting, really good terms with regards to their lender and servicer when exiting. A lot of people have been able to take those missed payments and put them on the back of the loan. That is including taxes, insurance, so on and so forth. All of this money has been able to be added to the back of the loan. No payments due. A lot of lenders are lowering the interest rates, even the principal balances on people's first mortgages, and taking part of that balance and adding it to a second mortgage and then lowering the terms on the first, really giving homeowners, borrowers, those that were affected by the pandemic, those that took forbearance, an opportunity to continue making their payments because we've talked, lenders don't want your property. As much information is out there that says lenders, are trying to take your property, the government wants your property. The reality is they don't. It costs them more money to foreclose on a property than it would be to continue servicing it as is. And we know that the CFPB wants servicers, wants lenders to work with homeowners to keep things moving in the right direction. The right direction would mean homeowners staying in their property, continuing to make payments, and these forbearance numbers continuing to decline. So let's take a minute and pull up this report. We're going to make it quick. I'll put a link to the full report in the body of the description below if you want to take a look at the entire report. But for now, let's take a minute, pull it up, and talk about the updated numbers with regards to forbearance. So as we see here, the national delinquency rate fell to 4.66% in April. Now, this is 1.5% above where it was prior to the pandemic. So we're still not back to where we were prior to the pandemic, but the numbers are continuing to decline. As you can see, the overall delinquency rate has been improving at a much faster rate than later stage delinquencies, which is a positive thing. But as of the end of April, there are still 1.8 million people with serious delinquencies, more than 90 days late. And that's 1.3 million more than prior to the pandemic. So what does it mean when they say 1.8 million people are seriously delinquent? That just means that they're 90 days late on their mortgage and haven't made a payment in 90 days. But that doesn't tell you that those people are actually in forbearance. They're allowed to miss their payments. So when you see these news headlines out there that read there's nearly 2 million people delinquent on their mortgage, they're not reading the fine print that says, hey, these people are allowed to be delinquent on their mortgage. Now, there's many of those people that actually need the forbearance that aren't able to make their payments, but at the same time, there's plenty of people in there taking advantage of the system, able to make their payments, but choosing not to do so and taking forbearance and using that money for savings, using that money to pay off credit cards, using that money for things that they probably shouldn't be, but taking advantage of forbearance. So when it says 1.8 million people delinquent, those aren't real delinquent people. Those people are allowed to miss their payments. And that's one thing that I want to point out to people because they don't understand that in most cases. So last month in April, over 400,000 people were cured of their forbearance in April. They were they left forbearance and were, set up on some sort of repayment plan. They either repaid their loan in some way by either selling or refinance, or they left forbearance and were given terms to, either reinstate their loan, as I mentioned, or maybe they were just able to pay the balance off and move forward with the current loan that they had before. So 400,000 people in April were cured. But which states are being affected the most? Which states are likely to get hit the hardest? So Hawaii and Nevada have the highest remaining per capita impact, with an estimated 4.1% in Hawaii and 4% of borrowers in Nevada that are still 90 days past due as a result of the pandemic. Now, again, part of these people don't need forbearance and are taking advantage of it. Part of them are. Now, why are Hawaii and Nevada? Nevada is a huge entertainment spot. Casinos were shut down. There was very little travel going in and out of Las Vegas, which is probably the largest city in Nevada with regards to money being spent, incomes, all of that good stuff, per capita, the number of people living in a city. And they were hit the hardest just because, all of those entertainment was affected, in a big way. And a lot of the people that live in that area work in the entertainment industry in some form or fashion, whether they're entertainers, whether they work in a casino, whether they work at the casino, whatever it is. These people are affected. Hawaii, on the other side, also huge restrictions with regards to travel, weren't really letting people come in or leave the state. They've been one of the last states to reopen, and therefore, their people were really affected there as well because, they're reliant on travel, and therefore, a lot of those people had to take advantage of forbearance, and or if they didn't, were delinquent because they were missing their payments. On the other side, Idaho and Utah are seeing the lowest per capita, with 1.2 and 1.4% of borrowers seriously delinquent because of the pandemic. But you can see up here, the cities hit the hardest: Las Vegas, Miami, New Orleans, Orlando, Houston, Atlanta, San Antonio, New York, Baltimore, Oklahoma. The best performing: San Jose, Salt Lake City, Milwaukee, San Francisco, Pittsburgh, Seattle, Boston, Denver, Detroit, Richmond. So metros that heavily rely on tourism have the largest remaining per capita impact, as we mentioned. Miami being at the top of the list there as well. Tech-centric markets like San Jose, San Francisco, and Seattle are all among the least impacted areas, right? A lot of these people are able to work from home. A lot of these people have high-paying jobs, the least affected. The number of active loans in forbearance has fallen to 2.18 million, and that's down, and that's as of May 18th. So at the beginning of the report, we talked about 4.55%. This is an update as of May 18th that we've fallen to 4.1%, and that's down 16% over the last 60 days. FHA and VA loans now make up 40% of all active forbearances. So FHA and VA are nearly at the top of the list for those that are active in forbearance. And forbearance starts have edged up in the most recent weeks. But why? Why have they edged up in the last few weeks? That's because a lot of people initially took forbearance 12 months ago, and they're at the end of that initial 1-year term, and they're able to extend it in some cases for an additional 3 months or 6 months. And so they're restarting because they're allowed to. They're able to restart that forbearance. And this is, it says it right there. The rise in restarts is primarily attributed to the large volume of plan exits that took place in early April. So these people are now entering back into that extension that they're allowed to take. These aren't new forbearances. These are people extending. And lastly, let's talk about what's happening when people are exiting forbearance. So 63% of those exiting forbearance are either performing on their loans or have paid their mortgage through refinance or the sale of their home. So 63% of the 70% that have left are back repaying their mortgage on time or have either paid their mortgage off. What's happening to the rest? Well, 5% remain past due on their mortgage, but are in active loss mitigation with their servicer. So 5% of those people have left forbearance and trying to work out a plan with their servicer, and 2% remain past due, but are not in loss mitigation. So 2% are past due, not doing anything about it. So that's really only 58,000 people we're talking here, because the other, 110,000 were already past due prior to the pandemic. But nonetheless, what I'm trying to get at here is the large majority of people exiting forbearance have either reinstated their loan or are paying on time, and that's really important as we discuss forbearance. And the next thing I want to talk about is the loans, right? Which loans are getting affected the most? Let's take a look at here. So, we're looking at CLTVs, combined loan to values here. And I'm not going to read this whole thing, but basically what it shows is of the estimated 290,000 loans in active forbearance with limited equity, the majority of them, 70%, are FHA and VA mortgages. Now, keep in mind, an FHA mortgage allows a 3.5% down payment. VA doesn't require a down payment at all. So you have to think these people didn't have 10% equity to start. So while equity is increasing across the board and these people are missing payments, these people are likely to be the most affected if we were to see any decline in home prices, or they're in a position not to continue making their payments and need to sell their properties at the end of forbearance, right? Because, if they don't have the amount of equity needed to sell their property, they're either going to have to do some sort of short sale or potentially, foreclosure if they stay in their property and don't work with their lender. But at the end of the day, we're talking about really small numbers overall. Now, some of these areas, are going to have more types of these loans than other areas. And if there is if you're in a market where the majority of loans are, say, FHA, or the majority of the loans are VA, then your market might be more affected by forbearance ending or some sort of decline in pricing over the next year or so. Whereas, if you're in an area where most people are putting large down payments, then you're less likely to be affected. The San Jose's that we talked about earlier, those San Francisco's, large down payments, those areas are less likely to be affected by those FHA, VA loans that could potentially go sideways if you were to see a change in the market. But what I've been talking about here since the beginning is how forbearance ending is less likely to be a problem than a lot of people want to chalk it up to be, right? Everybody wanted to initially look at forbearance as these people weren't going to be in a position to repay those missed payments at the end of the forbearance term, that they were going to have to come up with this lump sum. And if they weren't able to come up with that lump sum, then they were going to have to foreclose on their property. And the reality is there are other options outside of foreclosing. The lender is working with homeowners. That's important to know, people. The lenders are going to try to help homeowners come out of this. And we're seeing it with, what's currently being offered out there to those exiting forbearance. So just keep that in mind. And the only reason I bring this up, because I hear a lot of people sitting on the sidelines, or saying they're sitting on the sidelines waiting to buy a house, or waiting for the housing crash when all of these properties come to the market. And I just don't see that coming. And I'm not here to tell you that you need to buy a house now, but I'm telling you, if you're sitting on the sidelines waiting for that to happen, you're probably going to be waiting for a lot longer than just forbearance to end, because, the way I see it is these properties are going to trickle to the market. When they do come to the market, they're either going to be for sale, or, there will be some foreclosures as a result of it. Either way, it's not going to be this massive foreclosure wave or this massive wave of properties in one area that's going to change the environment of the market. And that's important to know. But, I'll continue to update you. June and July are huge months with regards to the number of people exiting forbearance. We're going to see, June and July are basically going to take the majority of those that are currently in forbearance out. And the numbers should decline substantially at that point. So, each month that we go by, we're going to get some really good numbers on what's happening with people exiting. and see how many people are still delinquent at that time. And that'll give us a better idea of, a market forecast, if you will, moving forward. And I'll continue to update you as those come out, but would love to know your thoughts. How do you feel like forbearance is going to affect the market? What are you seeing in your market right now? Are you seeing an increase in inventory? Are you seeing a decline in buyer demand? Or is your market still moving really, really strong? Let me know in the comments below. And as always, I appreciate you taking the time to watch. I appreciate the support, and I'll update you soon. Have a great day. Bye-bye.